Welcome to the Deep Dive. Today we're digging into ICF International, ICFI, and their Q3 2025 earnings call. And this was quite the quarter. You had this big internal strategy shift hitting, well, some major external turbulence, mainly from the federal side, caused a bit of a stir in the market.
It certainly did. Yeah, the stock dropped, over 6% right after the release. And our job here is really to unpack why. Because you look at the numbers, you see an EPS and revenue miss. Okay, but management, they were really pushing the story of solid margin execution and this huge bookings number.
Exactly. So how do those two things square up? Let's get into it. Okay, first, the numbers that, likely cause that immediate negative reaction, the headline stuff. GAAP EPS, $1.28. The non-GAAP number was $1.67. Both of those fell short. Consensus was expecting something more like $1.73, maybe $1.75.
Right, a definite miss there. And then the revenue side was maybe even more of a jolt, $465.4 million. Expectations were quite a bit higher, closer to, say, $485 million. And comparing year over year, it's a pretty stark picture, down 10% from $517 million last year.
Oof, yeah. A double-digit revenue drop, even when you're shifting strategy, that's always going to raise some eyebrows on the street.
Absolutely. It's hard to spin a 10% decline positively on the surface.
But, okay, this is where it gets interesting, right? Because management wasn't exactly sounding the alarm bells about their actual operations. You mentioned this hidden strength.
Well, maybe not hidden, but certainly resilient. That's the word they used. And I think it fits. Despite the revenue miss, they really held the line on profitability. Adjusted EBITDA came in at $53.2 million. That translates to an 11.4% margin. And here's the key part.
Yeah.
That margin actually went up 10 basis points compared to last year.
Up with revenue down 10%. How'd they manage that? That seems counterintuitive.
Yeah, it does. It boils down to a couple of things. One, just really tight cost management. They mentioned things like consolidating office space, keeping a lid on, discretionary spending, but maybe more importantly, the mix of contracts shifted favorably. Their gross margin actually expanded 50 basis points year over year to 37.6%.
50 basis points. Okay, so that suggests they were, winning or delivering more profitable types of work even as the overall pie shrunk.
Exactly. It shows that strategic shift towards perhaps higher value, more proprietary services was working on the margin front, even if the volume wasn't there overall. They defended the profit where they couldn't defend the top line.
Got it. And that defense, that really feeds into the main narrative here, doesn't it? This massive strategic pivot away from, the unpredictable federal space. How'd that look this quarter?
Well, it looked dramatic. I mean, the speed of the shift is pretty remarkable. You can almost picture ICFI as two different businesses right now. The non-federal part. It jumped up to 57% of total revenue. That's an 11 percentage point increase in its share in just 12 months.
11 points in a year. Wow. Okay. So that's clearly a deliberate move towards the commercial side.
Oh, absolutely deliberate. And pretty successful, at least in terms of the mix shift itself.
So what's driving that commercial success? Where's the growth coming from specifically?
It's really the commercial energy segment. That part of the business grew, get this, 24% year over year.
24%. Okay. That's serious growth.
It really is. And it feels like more than just a temporary bump. You're seeing utilities spending heavily on energy efficiency, on electrification, grid modernization, resilience, stuff ICFI specializes in. It's driven by regulation, by the energy transition. It's got secular tailwinds. That seems to be their new core engine.
Okay, so if commercial energy is booming at 24% growth and margins are actually improving slightly, how does the total company revenue still shrink by 10%? That brings us right back to the elephant in the room. The federal government business.
Yeah, the federal side was, let's just say it was a major drag. The federal revenue dropped almost 30%, 29.8% year over year, to be precise.
30%? Wow, what happened there?
Management blamed two main things. First, just general budget tightness across government agencies, which isn't unique to ICFI. We've seen that elsewhere. But second, maybe more acute this quarter, were significant procurement delays. They actually put a number on it. About $15 million of the Q3 revenue shortfall was directly because international government contracts got held up and federal procurement just slowed to a crawl ahead of the potential shutdown.
Right. The shutdown threat was looming in Q3, causing delays, and then the actual shutdown hit them in Q4 starting in October. Did they quantify that impact?
They did. They estimated the shutdown cost them about $8 million in October revenue alone. And maybe more critically for planning, they figured it was costing them about $2.5 million in gross profit per month. The shutdown continued.
Per month. Ouch. That kind of hit forces you to rethink things.
Absolutely. It forced them to revise their operating cash flow guidance for the full year 2025. They lowered it to a range of $125 to $150 million. Before, the target was around $150 million. So that reflects the hit, collections slowing down, payments getting delayed.
Okay, a cash flow hit makes sense. But despite that, they stuck to their overall 2025 revenue framework, as they called it. What exactly does that mean?
Yeah, that framework term is interesting. It's basically let's say their downside scenario planning. They're saying, even with all this federal mess, even assuming the shutdown drags on through the end of the year, they still expect the maximum revenue decline for the full year 2025 versus 2024 to be around 10%.
So they think the commercial strength is enough to offset even a prolonged federal freeze. That's quite a statement of confidence in the non-federal business.
It is. It suggests they believe there's a floor under the total business, primarily supported by that commercial energy momentum.
But if federal dropped 30% this quarter, that 10% full-year downside implies some sort of recovery or stabilization. How quickly do they actually expect the federal business to bounce back? That seems crucial for investors.
It is crucial, and I think that's where the market gets hesitant. Management gave a split forecast here. They said the federal IT modernization part, which is about half their federal work, should get back to growth sometime in 2026. That's things like tech upgrades, usually faster cycles.
Okay, 2026 for half of it. What about the other half? The programmatic federal stuff?
That's the slower piece.
Yeah.
That part, which is often tied to bigger, longer-term government programs and initiatives, they don't expect that to return to growth until probably 2027.
2027. So a significant chunk of their historical business might not grow for potentially another year or more after the IT side recovers.
That seems to be the message. Those big programs just take longer to get funded, get started, and recover from disruptions like this. And that 2027 timeline, I think that's definitely weighing on the stock valuation right now.
That makes sense. It adds a layer of uncertainty. But, okay, stepping back from the immediate political friction, the underlying demand signals, the pipeline, those seem pretty strong.
They were incredibly strong, actually. That's the other side of the coin. Look at the backlog. Still solid at $3.5 billion. And the new contracts they won this quarter, $714 million. That resulted in a book-to-bill ratio of 1.53.
1.53. So for every dollar they billed, they booked $1.53 in new work.
Exactly. That's a powerful forward-looking indicator. It suggests demand is definitely there, waiting to be converted into revenue.
And the pipeline behind that backlog is even bigger, right? Something like $8.4 billion.
Yeah, a massive $8.4 billion new business pipeline, which, as they pointed out, is like 4.3 times their last 12 months revenue.
That sounds almost too good to be true. I mean, a pipeline's great, but it's not revenue yet. What's the risk it doesn't convert or convert slowly?
That's the right question to ask. An $8.4 billion pipeline is fantastic, but conversion velocity is everything. The market needs to see that 1.53 book-to-bill isn't just, replacing shrinking federal work with maybe lower margin commercial work that's harder to ramp up. They need proof that pipeline turns into actual profitable revenue growth reasonably quickly, especially while they're also managing some leadership changes.
Right. They announced a succession plan, too. Let's touch on that quickly.
Yeah, pretty straightforward plan. The current COO, James Morgan, is set to take over as CFO after the full year 2025 results are out. And Ann Schote steps up to become president.
So continuity, but also pressure, especially for the incoming CFO, given the current cash flow situation, and focus on debt.
Definitely. He'll step in right as they're trying to navigate this federal uncertainty and deleverage the balance sheet.
And speaking of debt, what's the plan there? Paying it down.
That's the priority, yes. They reaffirm that. They want to get the leverage ratio down, expect it to be around 2.13 times at quarter end, hoping to drop it by another quarter turn by year end. The stated goal is to build capacity, get some dry powder ready for potential strategic acquisitions, likely in that commercial space, probably starting in 2026.
Okay, M&A potentially back on the table in 2026 once leverage is down. Interesting. So let's try to wrap this all together. We've got this incredible contrast. Booming commercial growth, collapsing federal revenue, resilient margins, huge bookings, but a delayed recovery timeline for part of the business. How's the market actually pricing all this complexity?
Well, the stock chart tells a pretty clear story of pessimism, at least recently. Over the last year, ICFI is down something like 53%, hugely lagging the S&P 500. And that 6.1% drop right after the earnings call, it screams that the market is laser focused on the near-term problems, the Q3 misses, the Q4 shutdown impact, the federal uncertainty.
So it's a classic case of management pointing to the future, the 2026 setup fueled by that book-to-bill, while the market is stuck on the present pain.
I think that's a fair assessment. The market's saying, show me. Show me the federal situation stabilizing. Show me that $8.4 billion pipeline converting into real revenue and profit growth now, or at least very soon. Until those things happen, the political overhang and the execution risk seem to be keeping a lid on the stock price.
So for you listening, what are the key things to watch, the potential catalysts that could change this narrative?
It's a pretty short list, really. Catalyst number one, a clear, decisive end to the federal shutdown mess, and, just as importantly, evidence that procurement processes are actually speeding up again. Those delayed contracts need to start hitting the books. Catalyst number two, proof of pipeline conversion. Seeing that commercial energy strength translate into strong, consistent revenue growth that genuinely offsets the federal weakness and validates that 1.53 book-to-bill isn't just noise.
Got it. Federal resolution and pipeline conversion. Okay, let's shift gears to our final segment. This is not financial advice, where we float a, let's say, provocative but maybe plausible trade idea based on everything we've just discussed.
All right. So given this stark contrast stock price for doom, but underlying operational signs pointing towards a potential 2026 recovery, the idea here is a kind of long volatility play, specifically targeting a delayed re-rating in 2026.
Okay, interesting. Long volatility on a delayed timeline. What's the actual premise and the trade?
The premise is that the market's reaction right now is, frankly, a bit excessive. It's hammering the stock because of the immediate federal chaos and the shutdown noise, pushing it towards the low end of even management's own stressed guidance. So the stock looks potentially cheap if you believe in the 2026 story, but the near-term risk is obviously very real. The trade idea, buying deep out-of-the-money call options that expire, say, mid-2026.
Deep OTM calls expiring way out in mid-2026. That's definitely a speculative bet. Why that specific structure and timing?
Because it's designed to capture the potential snapback if, and it's a big if, both of those catalysts we just talked about actually hit. One, the federal situation genuinely stabilizes, procurement unfreezes, maybe some delayed revenue gets caught up. Two, that commercial energy growth keeps humming along in double digits, proving the strategy worked. If both those happen, that 1.53 book-to-bill and that massive $8.4 billion pipeline act like stored energy, the political friction disappears, and the operational momentum could theoretically cause a pretty sharp upward move in the stock by mid-2026.
So it's a bet that the operational reality eventually wins out over the political noise, but acknowledging it might take a while.
Exactly. It's pure speculation on the fundamentals, eventually trumping the near-term sentiment. But the potential leverage is there if things break right.
It's certainly a bold idea, playing for that delayed gratification. Okay, so to quickly recap our deep dive on ICFI's Q3, we see a company really pushing through a major strategic shift, getting that non-federal mix up to 57%, powered by strong commercial energy demand. That part's working. But they're paying a steep price for it right now in terms of overall revenue, thanks to the significant drag and volatility from their federal business. And the market clearly focused on that cost, hence the stock drop.
Right. And the key question, I think, for you, the listener, looking ahead is this. Is management's forecast for growth coming back in 2026 too dependent on Washington getting its act together quickly? Or is that commercial energy engine truly powerful enough now to pull the whole company forward, even if the federal recovery is slower and bumpier, maybe closer to that 2027 timeline for the programmatic side? That's the calculation you have to make.
An excellent final thought. Remember, everyone, this deep dive was purely for informational purposes. It is definitely not investment advice. We're just aiming to get you up to speed quickly on the key dynamics. Thanks for joining us.